from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, powerhouse Peloton, the at-home fitness company, reporting sales more than double on digital growth, a day after recalling its treadmill products over safety concerns. We're going to get analyst reaction. Plus, the workplace evolution. Google now says employees can work from home from anywhere. Coinbase closing its San Francisco headquarters altogether. Redfin CEO Glenn Kelman joins us to talk about the post-pandemic working world and how it's shaping housing markets. And game on! Zynga's earnings gave a pop to shares after first quarter revenue beats. Zynga CEO Frank Gill joins me about the company's outlook, its chart boost acquisitions, and, oh yeah, what he thinks about the Apple Epic trial. All those stories in a moment, but first, U.S. stocks climbing on economic optimism ahead of Friday's jobs report. Our Kriti Gupta has the market picture. Kriti, take it away.
Well, Emily, it was a good day for tech across the board, but here's the thing. Big tech did not lead, and that's a pretty interesting dynamic. You're seeing this right here. The New York FANG index underperforming the S&P 500, even semiconductors, which have been dropping pretty recently. Flip up the boards, and I want to show you this trend that's kind of emerging when we're talking about tech. Remember when yields used to scare those big tech names? Now they're trading together. It's pretty interesting. For the last 4 sessions, you've seen the NASDAQ 100 and yields drop together all the way until the very end of today's session when you saw a little bit of an uptick in both. So that's going to be a trend we really want to watch. Something else we really want to watch is, of course, those earnings stories. Let's just get right to it here. You really are seeing Roku gain in after hours trading up a whopping 7%. Of course, it's coming after strong sales forecasts on that streaming growth. You also have Square reporting their revenue beating as well. Those shares seeing some love, not as much as Roku, but still in the green after hours. And then, of course, to the downside, we have Beyond Meat restaurant closures weighing on sales. That could come back in the back half of the year as we are all out and about. And lastly, Peloton, you know, it had that monster drop yesterday. Still gaining today in intraday session, but it looks like in after hours, it's back in the red. Investors really waiting for what's coming next on that company. Emily?
Absolutely. Kriti Gupta, thanks so much. I want to focus on Peloton and that eye-popping 400% jump in digital subscriptions. That good news, though, as the company also wrestles with the massive recall of all of its treadmill products. I want to get analyst perspective with Camilla Yanuszewski of CFRA. So, Camilla, how do you make sense of this? Obviously, digital sales going well, but the treadmill recall just announced yesterday, not good.
Yeah, definitely not good for Peloton shares. We do think that the market needs to separate what obviously is a tragic situation, that is being the death of a child. And then they need to separate that from the underlying fundamentals of Peloton, which we think is a very innovative and disruptive company. And we think the numbers they put out today were really great.
So do you think the numbers, though, keep going up even with this treadmill problem? I mean, I realize treadmills are still a smaller part of the overall pie, but the goal was to have them be a bigger part of the pie, right?
Yeah, the tread opportunity size is twice the size of bike, but currently majority of Peloton's revenues are bike. Nevertheless, though, we think Peloton's growth story is very much intact. And there are 3 key things we think investors should remember. First, this is not Peloton's first regulatory hurdle. Peloton has dealt with music litigation, and then they also dealt with a recall on their pedals a few years ago. And in all these situations, Peloton has come out stronger. Second, children are not Peloton's target market. So this is a very different story in terms of how this can impact demand or how this can impact reputation than, for example, a recall on toys or a recall on baby powder. And third, we think the tread is actually a very easy fix in terms of enhancing safety. Just 2 ideas I'd throw out there. They could put a bar underneath the machine or maybe even a sensor, and they could capitalize on the expertise of Atlas Wearables, which is actually a company they recently acquired.
Camilla, we were talking about this a little yesterday with our Mark Gurman, who covers Peloton. It's not unknown that treadmills can be dangerous. There have been accidents on all kinds of treadmills before, but Peloton is obviously such a big brand name. What is it that makes Peloton's treadmill more dangerous than other treadmills, or is it?
Yeah, absolutely. So these accidents do happen. There have been about actually 80 recalls of exercise equipment since 2000. And we think Peloton is under higher scrutiny because their brand has so much power. So they're automatically going to be in the public eye. And then also they do have a higher rate of injury versus other treadmills. And their treadmill is constructed a little differently in terms of the belt dynamics and also the height from the ground.
Now, one can assume that Peloton will overcome this. Like, as you said, they've overcome other recalls. They've also been dealing with supply issues pretty consistently through the pandemic. I know that delivery times are coming down, but what's your guess on when those supply issues won't be issues at all?
So from our understanding from the release, and obviously the earnings call is happening right now, is they very much mitigated all those supply chain constraints. And that's why gross margin was under a little bit of pressure, slightly below our expectations for the quarter. And that's because of the investments they made into air freight and expediting shipping.
All right, Camilla, well, I'll let you get off and listen into the earnings call. Thank you so much for your insight and analysis there. We'll be following along with you as well. Camilla Yanuszewski of CFRA, thanks so much for joining us. Now to another story we continue to watch, that is Tesla. Tesla has reportedly sold out its production capacity for the second quarter. This according to the blog Electric. The electric car maker sold a record of almost 185,000 vehicles in the first quarter, despite having some issues rolling out new versions of the Model S and X, something we will keep our eye on. Coming up, home prices soaring across the country as buyers fight over an increasingly scarce resource. New listings. We're going to talk to Redfin CEO Glenn Kelman about the company's first quarter results and how the housing market will shape up this year. This is Bloomberg. Google is giving its employees more flexibility to work from different locations or entirely from home, taking a more lenient policy as parent company Alphabet prepares for a return to the office after the pandemic. Other tech companies like Shopify, Slack, and Twitter have said their staff can work from home indefinitely. For more, I want to bring in Bloomberg's Mark Bergen, who covers Alphabet for us. So, Mark, this is a bit of a turn for Google because it seemed like they were going to take a harder line on this. What happened?
My hunch is you had a lot of employees that were unhappy with it. I think there's that, or there's certainly changing circumstances of the pandemic. But a key changes they made with this policy is that there are fewer people that are going to be required to come back into the office, and then some people will have the opportunity to relocate to a place with Google offices, which Google has offices pretty much in most major cities across the globe.
So this is a massive company. I mean, does everybody get this choice or only a certain limited number of people?
My understanding, there's certain divisions where they're going to want people in, certainly with people working on hardware. And so I think they're going to have teams that are much more required to come into the office, whereas other roles are going to be more okay to do remote.
So clearly this is going to be a talent differentiator. And I remember Eric Schmidt, of course, the former CEO of Google, saying that it's a war for talent in Silicon Valley. And that was a decade ago. It is still a war for talent. Is that part of the reason here, that they don't want to lose people and they want to make sure that they can recruit the best?
That's certainly the case, especially if you have a lot of competitors that are going fully remote. That is for both for recruiting and for retention, maybe become this new aspect that Google has to think about. Google has historically invested a lot in their real estate, in their offices. They've kind of rearranged their offices to operate more as kind of post pandemic, where you have people that they've hybrid offices where they can have people talk in video conference room as if they're there. And so they've invested a lot of time to have people return to the office. And so I don't think they're giving up on that. But they're surely much more amenable to employee concerns than they would have been a few years ago.
Right. It'll be certainly interesting to see in a few years if companies then change their positions that they've taken now. We shall see. Bloomberg's Mark Bergen, Mark, who covers Alphabet for us. Thank you. Now, as more companies like Google give employees the flexibility to work from anywhere, the migration from cities to suburbs continues. This, as mortgage rates in the U.S. dipped to the lowest level in almost 3 months, with more Americans competing for inventory that is going fast. Last time he joined us, Redfin CEO Glenn Kelman said the housing market is unlike anything he's seen before.
America is on the move, so right now inventory is rock bottom. It's like a Soviet-era supermarket. The shelves are completely empty. I have never seen any market like this.
Glenn joins us now to talk about the housing market and the company's first quarter results. Glenn, I will never forget your words there. Would you still characterize the housing market that way at this moment?
It might be more Bulgarian than Soviet. I forgot that I said that myself, but it has gotten worse. I think it's a 30-point drop in inventory. Not only is it the lowest level of inventory ever, it is the biggest drop ever in inventory. So once you start this cycle where people are scared to list their home because they're not going to be able to buy another place, it just perpetuates itself, and it's only gotten worse.
So why is the inventory low? Is it because people are scared? Is it because fewer people are moving? There was a lot of movement earlier in the pandemic. I feel like 3 people moved off my street. So what's happening?
Well, I think some of it is that we have doubled the rate at which people are buying second homes. So you have some people living in 2 homes instead of 1. You also just have really low interest rates. So when somebody contacts us about moving up, instead of putting their old place on the market, they decide to have someone else pay their mortgage. If you can rent the place out and keep that 2.5% or 3% mortgage forever, you will. And then some of it is that America just hasn't been as aggressive about building housing as it once did. There isn't a political consensus around it. It is hard to get the permits. The builders haven't always had the confidence, although now they're going crazy trying to catch up to demand. So we just have a lot of chickens coming home to roost where we should have been building a long time ago. And now that everybody wants to move, we're just trying to catch up.
Prices are also rising. Do you expect them to continue to rise through the end of the year? Like if you're looking now and you're having a hard time, should you be holding out for the fall, or is it only going to get worse?
I don't think prices will rise at the same rate. So it's a 20% year-on-year gain for the month of March, and that is a record gain. Most houses are now selling for above the asking price, which has never happened before. So I don't think that can continue. And what we've seen over the past few weeks is that some buyers are stepping back from these prices, but we still have so much more demand than supply that we are going to be supply constrained regardless. Lots of people are touring homes. They're just worried about being able to win the bid. And then even when they do win the bid, they're worried that their loan won't go through because the appraisal is going to come in so much lower than what they offered to pay. So I think you are going to see just a little bit of air come out of the balloon. It's not that prices are going to fall. They're just not going to rise quite as much. The only factor that's driving this is that if you are leaving San Francisco for Boise, Idaho, it doesn't matter if the price is double or triple. It still feels like you're paying a monopoly money because people are paying less for the home in Ohio, in Nevada, in Idaho than they were in California or New York. And that's why prices have been able to rise so much, because so much of this is driven by migration.
Meantime, you have companies redefining their policies about whether to come in or not. Google was going to take a stricter stance and wanted everyone back to the office. Now they're saying a large number of people can work from home forever if they want. Coinbase is selling its San Francisco headquarters. They're all remote forever. How do you expect these dynamics to impact the market over the next several years as these policies work themselves out?
Yeah, well, what we've seen in our own data is that about 4 out of 10 Americans who were using our website thought they'd be able to move away from the office at the beginning of the pandemic. And now, even as the pandemic eases, it's 6 out of 10. So fewer and fewer offices are able to hold the line. Even when you see a company like Google try to get people back, they've invested so much in their office, but people don't want to come back. And so that is just going to liberate more Americans to live where they want, to pursue more affordable housing, to be able to get a larger lot and a better life. And what we found is unprecedented rates of happiness. Usually when people move, they're moving up and they have less disposable income. But our survey data shows that now when people move, they actually have more disposable income. They're getting a bigger house for less money than they would have paid in California or New York or some other coastal city. They're moving to a lower tax place. And so they get this better life and they have more disposable income. Sometimes it means that 2 parents were working and now only 1 parent has to work. It's really been kind of like discovering plutonium for some families. And that's not the usual hangover we see. Usually when people bid crazy in a bidding war, they really wake up the next morning with quite a hangover, wondering what they've done. But people now are just very happy after they've made that move. And so that's why I think this trend is only going to continue for years to come, not just for months.
Redfin shares down quite sharply on the back of your results. A wider loss than, yeah.
Oh, man,
wider
you gotta
loss
ask me
than
this
some
every
had
time.
expected. I have to ask you, what's your response? What do you want to say to investors right now?
What I said in the earnings call, we nearly tripled our market share gains. We've tripled the rate at which we're able to get people into homes fast, which is the fundamental measure of how you compete. The business is in a better competitive position than it ever has been. The stock is up 5x over the past year. I just can't be worried that it went down one day. And it's always the day that I go on your show, but it'll be up again next week or next month because we're building an incredible company for the long term. And I know you think that I'm just saying this, but I don't have to say it. I want to say it. And I believe it all the way down. That's my answer.
Glenn, we'll have you back anytime, whether the stock is up or down. All right, you have my commitment right there. Redfin CEO Glenn Kelman, thanks so much for joining us. Always appreciate it. All right, coming up, booster COVID shots. Will we need one to fight the variants? That's next with Moderna co-founder Noubar Afeyan. And as we head to break, vaccine stocks, including Moderna, sank after German Chancellor Angela Merkel rejected a U.S. proposal to waive patent protections for COVID shots. We're going to keep an eye on developments there, bring you the latest. This is Bloomberg. Jeff Bezos sold about $2.5 billion of Amazon stock this week. It is his first big disposal this year after offloading more than $10 billion worth of shares in 2020. In a filing, Bezos signaled that more sales are on the way. The world's richest person still holds more than 10% of Amazon stock. And Moderna is out with new data that shows its COVID booster shot is working against dangerous variants out of South Africa and Brazil. The trial is still gathering data on other boosters. Does it mean we'll need more shots? I spoke with Moderna co-founder Noubar Afeyan. We're just getting some new headlines that Moderna's booster shot works well against variants. This is part of your mid-stage booster trial. How important is this news?
You know, I think that it's very significant because every version of products that we can advance and show efficacy and safety in is ultimately tied to saving lives. And as the virus changes its tactics, its stripes, if you will, through mutations, so that we have a harder time with our immune systems necessarily identifying it and targeting it, so should our vaccines respond a step ahead and boost our immune system's ability to tackle the threat. And so, you know, when we say threat, we think it's one threat, but it turns out it's many threats now because it's diversifying. And so our vaccines have to deal with that. And I think for the first time, we've shown yet again, as we did a year ago roughly around now in early May, for the very first time, an mRNA vaccine against COVID. The data, Moderna's data, I'm proud to say, was the first, and it really led the way to others who followed with RNA technology. Same here. I think it's a first in that the booster both is showing what an increased immune response to the existing vaccine accomplishes against variants, but also what the variant vaccine-based booster does to the variants. And it bodes well because just as this data is going to be coming out, we also are seeing strains in India that seem even more ominous than the South African one. And so the question will be, how's that going to fare against these new boosters? Do we need another booster?
So does that mean we're going to need a third booster or even a fourth booster, or is this going to be combined in an annual shot that we get next year?
I think a booster is safe to assume, perhaps later this year, being important to have. Whether you need a second one or a different one, depending on what viral threats we're counting, we have to see. And then your point very appropriately is we think where this is going to head potentially is that we have a combination of a flu and a coronavirus vaccine booster. That's a seasonal thing that just covers particularly the most vulnerable, let's say the older population, comorbidity population, and potentially a broader group of people.
Any update on a vaccine for kids? Mine are 8 and under. Pfizer has been reporting some progress with their childhood vaccine. When will my kids be vaccinated?
Yes, well, I can't give you a very date certain on that, but I could say by the fall, both companies certainly should have data on vaccinations from 6 months to 12 years. Both companies have data. Pfizer's been a little bit in advance because their EUA was achieved a little earlier, so they started on the 12 to 18 range earlier, so they've already come out with data. I can't forecast, but I don't expect, given the technology is one and the same, that it's going to be very different. I hope it's the case. So we should have an application in the teenage area once we get the data that we can release, and that will then move the age down to 12, and then from 6 months to 12 years, forthcoming months, the trials are ongoing.
Moderna co-founder and chair there, Noubar Afeyan. We'll get more of that interview with him next week as we highlight biotech and life sciences in the Boston region in a special on the economic recovery of Boston. Of course, Noubar based in Boston, as well as his flagship Pioneering. Don't miss it. Meantime, we're getting some headlines from the Peloton earnings call. The company saying it's going to postpone the launch of its cheaper treadmill from May 27th. They will release that when regulators approve that. This, of course, on the back of that massive recall, will continue to follow. More of Bloomberg after this quick break. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get a quick recap on the markets with Bloomberg's Kriti Gupta in New York. Kriti, what are you watching?
Well, Emily, let's just start off macro. It wasn't too long ago we were talking about the NASDAQ 100 at record highs, but in the last 2 weeks, totally different story. You can really see it get pared back from those record highs. Let's see if that downtrend really continues. And of course, when you see performance like that, it really brings up questions about the very famous Cathie Wood ARK ETF. And that's really been in the limelight lately because, of course, it was thriving in 2020 when that tech trade was really thriving too. Flip on the boards, and I want to show you the outflows from that ETF. You've just seen the series of outflows lately. Some of that, of course, coming from just the risk sentiment turning around. Some of that coming from that tech underperformance. It's really interesting. Let's dive in just a little bit deeper and focus in on one video game stock in particular, Activision Blizzard, and what it's been doing this week. A fun fact, Emily, when I first started doing markets reporting, I was a video game beat reporter. And this is really why this caught my eye, because you actually tend to see some pretty strong earnings coming out of these video game companies, especially last year in 2020. And that's really what you saw on Tuesday, that massive beat off earnings, but then paring back some of those gains. And then again today, actually able to hold some of those gains. And this is going to be a pretty interesting thing to see, that even after that massive pandemic bit of 2020, can these stocks really hold on to their momentum? Something to watch in the days to come, Emily.
All right, Kriti, thanks for the personal history there. Appreciate it, Kriti Gupta. Thank you. Sticking with gaming now, Zynga reporting earnings this week, topping sales forecasts and bullish on the remainder of the year. Although COVID restrictions are starting to lift across the country, the game maker still maintaining this year's profit outlook. citing investments into advertising, cross-platform play, and hyper-casual games. For more on the company's predictions in a post-COVID world, we're joined now by Zynga CEO Frank Gill. Frank, always good to have you here on the show. So the pandemic is weighing, but game usage is staying up. Why is that?
Well, it's interesting over the last few quarters as we've seen people start to return to work and go back to school and their lives begin to go back to normal. Engagement in mobile games has continued to rise. And I think it's because you can take your mobile game with you as you go back to a post-COVID, more normal lifestyle. It's a very flexible game in terms of it's free to play. It's on your phone. You can play it for as long or as little as you want. So it's very resilient in these times where things are so much in flux. And it's really encouraging to see engagement continue to grow even as people go back to work and go back to school.
Now, you've also got some new game launches coming up. Farmville 3, Star Wars Hunters. How long do you think you can benefit from this boost? And does it abate? And if so, when?
You know, that's hard to say, but as each month goes by and each week goes by, we continue to see engagement and participation in our games. The audiences grow every week and every year. And so it's exciting to see with new releases like Harry Potter last year, the ability to establish an all new franchise for Zynga. And this year, we've got Farmville 3 coming in the end of summer, as well as Star Wars Hunters, which is our first cross-platform play game coming out towards the holidays. So, people are looking for things to do, new games to play, new social relationships to build, and our products really do a great job bringing all those together.
So in other app and high-profile gaming news, we've been following the Apple Epic trial very closely. Apple executive Matt Fisher, who runs the App Store, actually took the stand. What is your position on this lawsuit? Who's in the wrong? Who's in the right?
I think from our perspective, we're just taking a wait-and-see stance to see how the courts decide in terms of these issues that are at play. We have partnerships with both companies. We use Unreal engines for development of our games, as well as have been a great partners of Apple's for many, many years. So from our perspective, we're not really picking sides. We're just going to wait and see what the courts have to say and then adjust our business accordingly.
What is the impact of Apple's commission structure on Zynga? I mean, are there times where you think to yourself, this is unfair, or do you think it's fair for the service that Apple provides?
I think if you look at any of the platforms we're on, whether it's Android or iOS, the payments that we make to those platforms are in return for services and the value that they create. And sometimes you feel really good about that relationship, and sometimes you're scratching your head a bit. And when that occurs, what we do is we talk to our platform partners directly, point things out, try to make adjustments in the types of promotions and marketing and technical support that we receive, so that we're receiving the maximum benefit possible for the payments that we make. And it's an ongoing relationship. It evolves over time. And I think that what you see in this case is a question about what types of services are provided, how valuable are they, and how open do they need to be. And I think any of those issues that they're touching on in the courtroom will impact Zynga. The good news from our perspective is that any shifts there will likely be a tailwind for our business, as opposed to any other friction that we might encounter.
Why is that? I mean, is there an outcome that you're hoping for?
Well, I think that, again, it's too hard to forecast right now with a case underway and not all the witnesses having testified yet and all the evidence presented. So it's difficult to really project what's going to happen. It's certainly outside my area of expertise. But when we do look at some of the issues at hand, if platforms open up more, if there's more options for publishers to be able to build relationship with their customers, that's not a bad thing from our perspective.
Now, you're also buying a mobile ad platform called Chartboost. This at a time when Apple is cracking down on ad tracking practices and making it more difficult to do that, focusing on user privacy. How do the changes that Apple is making in that arena impact Zynga?
Well, I think we've been through this a little bit already with the European rules that have been implemented with GDPR, as well as states like California have implemented specific privacy protections for players. And protections of our players' privacy is important to us. And what it really does is it just changes some of the rules for how we go out and acquire users, bring them into our services and our games, as well as advertise and make products available to them. So a company like ourselves, we're at scale. We have a very large audience base, a very diverse portfolio of games. And now our relationship by purchasing Chartboost gives us the ability, frankly, to really see the market much more broadly in terms of what's happening in terms of acquisition, how they flow through to the games, and be able to serve our players better from a game and services standpoint. So as these rules adjust and change, we'll adapt accordingly. But we're very confident that these adjustments due to IDFA will actually probably present more of an opportunity for Zynga long term than actually a headwind.
We've seen a lot more school children using gaming, integrating gaming into the curriculum. You know, and I wonder if you see more of that going forward. I think, you know, parents and schools have often been resistant to it, but this year they had no choice. How does that change going forward?
Well, actually, most of the customers for Zynga are busy adults, actually, and the majority of our players are women. We don't have a lot of businesses that kids are participating in, but you know, I'm a believer in interactive entertainment as a form of entertainment that helps challenge your brain, develops your thinking, builds social relationships. So it's exciting for me to see this type of interactivity start to come into the learning process, because I believe it'll actually lead to a more engaging and rich experience for the kids. Of course, you know, you got to get your homework done. So, you know, you got to limit the time that kids play on games at night so that they can really focus on what they need to get done from an education standpoint. But if it's well managed, it can be a wonderful part of how people build out their relationships and how they enjoy themselves in the free time that they have.
All right, Frank Chabot, always good to have you here, Frank. Thanks so much for stopping by, CEO of Zynga. Well, in part thanks to the pandemic, as we discussed, the video game industry is now bringing in a whopping $180 billion in revenue a year. Video games have invaded schools, as we discussed. Gaming live streams are dominating social media, but the industry may be more volatile now than ever. Press Reset, Ruin and Recovery in the video game industry takes a look at the industry's darker, more unstable side that can swing from the euphoria of a hit game to a studio closing and mass layoffs with a failed one. Joining me now for more is the author of that book and Bloomberg's very own Jason Schreier, who covers the gaming industry for us. So, Jason, really excited about your book. I've had a look at my advanced copy and really enjoyed it. But what are you going to tell us? Tell us more.
Thanks so much for having me and for the kind words, Emily. Always good to be here. Yeah, so this is a book. Of it as a bleak but optimistic book because it looks at the video game industry's problems and how, even though it is as rich as you say it is, bigger than Hollywood, it seems to be unable to keep its workers healthy and happy and satisfied and fully employed. And many of them are constantly burning out and leaving the industry for more lucrative ones. Yet, I think it's an optimistic one because the book also looks at ways in which things can change. It presents solutions. It presents opportunities, one of which being remote work, which is something we all got to experience over the past year. Others being unionization and other things like that. But yeah, the book looks at a bunch of stories of game studios closing and what happened to the people involved, how they felt about it, and then how they recovered. And it's all based on firsthand reporting, interviews with the developers, and yeah, I think it will resonate with a lot of people out there.
So, as you mentioned, the gaming industry is bigger than Hollywood, and I think a lot of people don't realize it's bigger than TV. It is bigger than movies. And if this industry is bringing in so much money, then why is it so unstable? Why are, so many of these gaming companies not wonderful places to work?
Yeah, it's a good question. And I think that a lot of the case studies that I found that I analyze in this book are, of course, failed games or companies that simply ran out of money and could not make it work because it's a very risky business. It's a business where you have to invest tens of millions of dollars and many years of people working just to compete with the biggest games. And so of course, companies can fail at that. But even the successful studios can sometimes shut down. I profiled a studio called Irrational Games that was known for making a series called BioShock that was extremely successful, and even that studio, for a variety of reasons, had to found itself shutting down. Essentially, the director of the studio said he didn't want to do it anymore, and it led to the publisher closing it. Sometimes it's mismanagement. Sometimes it's just the risks are too high. Oftentimes, and this I think is pretty remarkable. Oftentimes, it is that a company is making a game and it's successful, but maybe the next game is not is profitable, but not exponentially profitable. It's not completely successful enough. It's not wildly successful enough for the publisher involved to justify keeping those people around. And so they moved some spreadsheets around, moved some numbers around, and they decided we're going to lay off a whole bunch of people. Just a few months ago, we saw Activision laying people off. Just 2 years ago, we saw them lay off nearly 1,000 people, while at the same time, literally the minute that this was happening, that Activision was laying people off, its CEO, Bobby Kotick, was on an earnings call saying Activision just had its most profitable quarter ever. So yeah, I mean, unfortunately, that's the reality of the games industry.
I'm sure that doesn't do a lot for morale, Jason. The gaming industry has also historically been very male-dominated in terms of the players and the customers and also the people making the games. But we just heard the CEO of Zynga say a huge majority of his customers are adult women, and the industry is changing. But I wonder how much it's changing. What percentage of gamers are women now? What percentage of gaming staff, game makers, are women?
Yeah, the last stat I saw was that about 45% of game players are women. Now, that stat needs to be contextualized a little bit because that also includes Zynga games. It includes mobile games. It includes Facebook games. It includes a lot of games that have larger female demographics. But still, we are talking about a world where women are playing games like long gone, I think, at least from what I've seen covering this industry for more than a decade. Long gone is the stereotype of the teenage male basement-dwelling gamer with acne and eating Doritos, smudging his controller. I think that games are very clearly bigger than that. Games are very clearly part of our culture, and I think that the industry has changed to support that. What we've seen is really it's such a young industry, and that's something that I examine a little bit as well in the book. Is that it's going through growing pains that I think other industries went through a while ago. Hollywood, for example, is 100 years old. Gaming is really only 40 years old or so. And maybe 20 years ago, in the 80s, 90s, game development was essentially a bunch of men, and that at that point it was largely men, maybe working out of the same house and staying up all night eating pizza and drinking Diet Coke. Essentially, it was nerd frat houses where they all made games together. And since then, the industry has professionalized. We've seen legitimate companies, HR departments, and there's still a lot of growing to go when it comes to making sure that women are given the same opportunities. But as you know very well, Emily, it's the same exact situation in tech. So that's really a global problem.
I was just going to say it sounds a lot like Silicon Valley, a young industry with a lot of growing still to do. Well, definitely check out Jason's book, Jason Schreier, Bloomberg Technology, who has a new book out called Press Reset that dives into all of this fascinating lore. All right, coming up, a breakthrough in the chip sector. IBM unveils the world's smallest, first 2-nanometer chip that could beat the performance of all existing products, they say. We're going to speak to the director of IBM Research, Dario Gill, next. This is Bloomberg.
We have a lot of work on 5, 3, 2 nanometers just to sort of categorize where we are. And just by the way, the world today is at 10 and 7 nanometers. So we're talking about the next generations.
IBM CEO Arvind Krishna there speaking about a month ago about the next generation of chips, and it is here. IBM now introducing the world's first 2-nanometer chip, roughly the size of a fingernail, that could potentially transform the industry. This as the global chip shortage stretches into its 5th month, worsening the impact on sectors ranging from cars to smartphones. Joining us now, Dario Gill, IBM Research Senior Vice President and Director. So Dario, this is a huge leap in technology. First of all, how did you do this, and what opportunities does this open up?
So yeah, it is a big deal because it's not very often that we make a breakthrough in technology that can lift all boats. And we gotta remember that behind the scenes of our computers and our phones and our cars and every gadget that we have semiconductors and chips. And at the bottom of them, there's these transistors that are the basis of the digital world of zeros and ones. And what we've achieved now is the fruit of 4 years of work of hundreds of scientists and engineers working in Albany, New York, in a facility that has been the product of $15 billion of investment over the last 2 decades. So it's quite a feat of science and engineering. And in the end, what it's going to deliver for us is the proof that we have the next, future node for the semiconductor industry beyond, the 7, 5, 3, and now the 2 nanometer node.
So who's going to manufacture the chip, and when will it hit the market?
So what we enable with these breakthroughs, the way the business model works and how we conduct R&D in semiconductors is we build an ecosystem. And in our Albany facility, we have equipment manufacturers. This is companies like Applied Materials, Intel, and ASML. You have materials companies like JSR and others. And then you have manufacturers like Samsung. And we announced earlier this year that Intel is going to be joining as well, collaborating with us in semiconductor research. So what happens when we develop an advanced node like 2 nanometers is bilaterally we enable the technology elements that make the node viable to each one of these parties, so that the equipment makers can make the next equipment and the manufacturers get the license to scale it. So you will see the technology over time scale in the large foundry makers like Samsung and others, and and ultimately other IDMs like Intel.
So when will a 2 nanometer chip be in a product that I might use?
So I was mentioning before that 7 nanometers in production. So you would expect, if things go according to plan, late 2024, maybe 2025 is when you would start seeing the 2 nanometer node entering production. And what that will enable then is, all the people that can benefit from chips to design against that technology and get those chips fabricated. And just to give you a sense of the value that it can provide, a phone, a state-of-the-art smartphone that we all use today, typically built with 7 nanometer technology. With this 2 nanometer technology, you could deliver the same performance, but with a battery that would last now 4 days because it's so much more efficient. Or if you wanted to maintain the same battery performance, you could make the phone 45% better in terms of performance.
So that is just absolutely fascinating. IBM Research Director and Senior Vice President Dario Gill, we will be watching as this technology develops. It would be wonderful not to have to charge my devices for a full 4 days. So I'm excited for it. Thank you. All right, coming up, small retailers using Amazon to catapult them into global brands. We're going to get a first-hand account of that strategy next. This is Bloomberg. E-commerce is booming, and bigwig financial firms like JP Chase are buying small sellers on Amazon with the goal to launch them into global brands. Bloomberg's Ivan Levingston takes a closer look at this phenomenon.
Small retailers on Amazon.com are getting bought up by the dozens with the help of billions of dollars in funding from investors. Even before the pandemic, online purchasing was on the rise. E-commerce is booming, but it's been accelerated by the coronavirus as consumers stuck at home drove up digital sales. Meanwhile, retailers shuttered thousands of brick-and-mortar stores as pandemic lockdowns and restrictions ravaged their business models. Amid that shift, a new class of companies is vying to become the next Procter & Gamble or Unilever of the future, a conglomerate of consumer brands. And these aspiring giants are going about it by purchasing sellers on Amazon. Some of the biggest names in finance, like JP Chase and Advent International, are putting their money behind these companies. It's a trend that cuts across private equity, investment banks, and venture capital firms. These investors funded roll-up firms to the tune of $1.4 billion in debt and funding in the first quarter of this year. Just through mid-February, nearly 3 times the amount raised in the prior quarter. About 40 of these companies have emerged in recent years, with most quietly seeking deals behind the scenes. The pitch from such aggregators is that they can help smaller retailers expand their business, including taking them international while finding synergies on the back end in areas like logistics. Some of the key names are companies like SellerX, Perch, and Heyday. One leading firm has purchased 100 Amazon businesses with a portfolio of more than 15,000 consumer products. And the fundraising hasn't stopped. One company, Branded Group, said in February that it had bought 20 houseware and leisure brands after raising $150 million. In mid-April, another one, Berlin Brands Group, raised $240 million in debt to buy up retailers on Amazon. It had $400 million in revenues last year and wants to become the largest acquirer of direct-to-consumer brands in Europe. Since funding seems to be accelerating, there's no end in sight to the race for these deals. This is The Venture. I'm Ivan Levingston. For more content like this, you can follow us on all of your favorite platforms.
Bloomberg's Ivan Levingston there. And that does it for this edition of Bloomberg Technology. Tomorrow, we're going to hear from the CEO of Blue Apron, Linda Kozlowski, after earnings. Thanks so much for joining us. I'm Emily Chang. This is Bloomberg.